As of this moment, SoFi Technologies, ticker SOFI, is trading live at $27.22 per share. That represents a drop of about 60 cents or 2.14% in today's session. And right away, that intraday pullback is what many people are looking at, but they are focusing on the wrong thing. This isn't a story of weakness, it's a story of digestion. The market expectation for SoFi for years has been straightforward. It's the company that helps people with student loans. Then, after a long process, it became the Neobank that finally secured a national bank charter. That is the simple, easy-to-understand box that most of the market, and maybe even you, have put it in. But the reality, as we're seeing in late 2025, is that this company is an entirely different animal. The student loan narrative is old news, a fraction of the current operation. The real driver today is the aggressive execution of its one-stop-shop strategy, the explosive growth in its non-lending financial services, and the quiet, high-margin technology platform, Galileo, that it owns, which many of its own competitors actually pay to use. Today's pullback after a blistering run-up this year is just noise against the backdrop of a company that recently delivered its 8th consecutive quarter of GAAP profitability, a milestone many fintechs never reach. Let's look at the tape. The volume today is active, already clearing 14 million shares, and we are seeing a clear battle line drawn by algorithms and day traders. The 52-week high of $32.73, which we saw just last week, is acting as a strong resistance level. The stock has run up over 81% year-to-date, so a pullback like this is not only normal, it's healthy. The big headline that everyone is latching onto is the recent relaunch of SoFi Crypto. After pausing the service to navigate the complex regulatory environment post-charter, SoFi just became the first nationally chartered FDIC-insured bank to offer direct cryptocurrency trading to its members. The expectation is that this is a massive new business line. But let's be clear-eyed about this. The reality is that the direct material impact of SoFi Crypto on the bottom line in the short term will likely be minimal. The company isn't going to get rich off Bitcoin trading fees. The real value here isn't the revenue, it's the stickiness. It is one less reason for a member to leave the SoFi app. If you are already using SoFi Invest for your SoFi stocks or SoFi ETFs, you no longer need to jump over to a separate Robinhood app or another platform to get your Robinhood crypto exposure. You can do it all from one place. This is the entire thesis in a nutshell, building an ecosystem so comprehensive that you never need to leave. This move has rattled some. We saw Cathie Wood's ARK Invest, for example, trimming some of its position last week. That kind of news always spooks retail traders who follow her moves. But this isn't just about Robinhood stock trading or crypto. This is about building a full-service financial ecosystem, something that legacy firms like Fidelity, with all their Fidelity investments, Fidelity brokerage services, and Fidelity mutual funds, are trying to bolt on, while SoFi is building it as the core foundation. The daily swings are just a distraction from the underlying machine. If you want to understand the reality of SoFi Technologies, you must ignore the daily crypto noise and look at the Q3 2025 earnings report they just delivered. The numbers are frankly staggering. They reported record-adjusted net revenue of $950 million, up 38% year-over-year. This was their 8th consecutive GAAP net income, coming in at $139 million. Think about how many high-growth tech stocks, from Tesla in its early days to countless others, burned cash for decades. SoFi is profitable, and that profitability is growing. But here is the most important metric: member growth. The company added a record 905,000 new members in the third quarter alone. Total members now stand at 12.6 million. And even more critical is product growth, which hit a record 1.4 million additions, bringing the total products to 18.6 million. This is the cross-selling. This is what CEO Anthony Noto calls the flywheel. A member comes in for a personal loan, they stay to open a SoFi Money account because of the high-yield savings, then they open a SoFi Invest account for some self-investing, and maybe they add the credit card. This is a strategy that Schwab Intelligent Portfolios has used effectively in the wealth management space, but SoFi is applying it to the entire consumer finance vertical. And the segment breakdown from that earnings call tells the full story. For the first time, the financial services and technology platform segments together generated over $500 million in revenue, $534 million to be exact. That was up 57% year over year. This officially means SoFi is no longer just a lending company. The lending business is now the stable, profitable workhorse that funds the high-growth new ventures. The financial services segment, with its SoFi investing platforms and the SoFi Technology segment, are the future. So what is the SoFi business model? It's really three distinct companies under one roof. First, you have lending. This is the legacy. Student loan refinancing, personal loans, home loans. They target high-earning, high FICO score individuals, which is why their credit quality has remained remarkably high. This isn't subprime. It's prime and super prime customer base. Second, you have financial services. This is the bank part. SoFi Money, which is their checking and savings product. SoFi Invest, which includes the SoFi Active Investing platform and the SoFi Robo-Advisor, the SoFi Credit Card, insurance products, and now SoFi Crypto. This is the high-growth member acquisition engine. It's designed to bring people into the ecosystem at a low cost. And third, and this is the part many analysts believe is still undervalued, is the technology platform. SoFi owns Galileo. Galileo is the back-end, the API-based plumbing that other fintechs and even non-financial companies use to build their own financial products. They also own Technesis, a digital core banking platform. This segment is high-margin, fee-based revenue. So while you might be looking at Interactive Brokers for its advanced Interactive Brokers trading tools, or Fidelity for its Fidelity IRAs and Fidelity Wealth Management services, many of the new fintech apps you see on the market are actually paying SoFi, Galileo, a fee on the back end for every transaction. Now we have to talk about the bank charter. This was the big story a couple of years ago. The expectation was that this charter would provide cheap deposits and supercharge growth. The reality is more complex, but it has been a massive tailwind. It allows SoFi to use its own member deposits, which totaled over $25 billion back in 2024, to fund its own loans. This is dramatically cheaper than relying on high-cost warehouse facilities, which is what they had to do before. It's a key reason why their net interest margin was a very strong 5.84% in the last quarter. That's a margin many traditional banks would be envious of. But here is the risk, the other side of that coin. That national bank charter also brings massive, smothering regulatory scrutiny. This isn't the move fast and break things fintech world anymore. SoFi is regulated like a major bank, which can slow down product rollouts and increase compliance costs. This is the tension at the heart of the company. And this brings us to the valuation. This is the core of the bear argument. Even after today's 2% drop, the stock trades at a price-to-earnings ratio of nearly 50. That is far higher than any traditional bank and is more in line with a high-growth tech stock like NVIDIA stock or Apple stock. That valuation is pricing in a lot of future growth. In fact, some valuation models, like the FAIR ratio, calculated by Simply Wall Street, suggest the stock might be overvalued right now, with a fair value closer to $26, which is below its current trading price. The consensus analyst rating is a hold. According to recent data, 54% of analysts covering the stock rate it a hold, with 23% at a sell. Only 15% are at a strong buy. The professionals who run investment models all day are deeply divided. The bull-bear debate on SoFi is one of the heatest on Wall Street. This is where the debate really heats up. SoFi has been a phenomenal performer for anyone who bought in at the lows, but at this valuation, it's a show-me story. Comment below with what you think SoFi's biggest growth driver